Good afternoon. Today we're going to start Accounts Receivable, the audit of Accounts Receivable. She discovered that a new real-time system for processing sales transactions. As soon as we see something new, a new system, a change in a system, we need to be very cautious and assume there's higher risk. When we do something over and over, we tend to get better at it. If we try to do something new, we're usually not good at it for a while. So new systems, changes, be suspicious. We had a table like this earlier in the quarter. Sales are up 9%, gross margins up even more, 9.6%. Accounts receivable are up 15%. Why are accounts receivable up more than sales? I don't know, but I need to figure it out. Allowance for doubtful accounts and bad debt expense are down relative to last year. If sales are up and accounts receivable are up, why is bad debt expense down? I don't know. I need to figure that out. Number of accounts receivable increased by 37. Number of large accounts receivable increased. One way to increase sales is to lower credit standards. So obviously it's not the same customers buying more, it's new and different customers. The ratios tell the same story. Gross margins up. Bad debt expense is down. Allowance for doubtful accounts is down. Number of days outstanding hadn't really changed much. Receivables as a percent of total current assets is up. So this doesn't answer any questions, but it raises some questions. I need to look at accounts receivable and sales very closely. 500, you know by now. The audit risk model, we treat plan detection risk as a function of control risk. If control risk is low, plan detection risk is high. If control risk is high, plan detection risk is low. If plan detection risk is low, if we believe their controls are effective, if in fact their controls are effective, then control risk is low and plan detection risk can be high. We can limit the extent of our substantive testing. We can rely on their internal controls and limit our substantive testing. If we believe their controls are not effective, then we'll assess control risk as high and plan detection risk must be low, and we must perform extensive substantive tests. Limited and extensive are the words of the profession. We want to use them. We reduce detection risk by performing substantive procedures. If plan detection risk is low, doesn't mean detection risk is low. We're sitting there with our paper and pencil and we say, oh, plan detection risk must be low. We have to reduce it. We have to go out and perform substantive procedures in order to reduce detection risk. Controls are ineffective. We assess control risk as max. That's 1. Which audit approach are we going to take? We'll take a primarily substantive approach, and plan detection risk must be 0.05. If we assume auditing by the way, auditing standards don't specify what acceptable audit risk is. Ted just made this up. So we're going to pretend auditing standards require acceptable audit risk to be 0.05. Or Ted, the audit partner, says it's got to be 0.05 or less. Controls are somewhat effective, not great. We preliminarily assess control risk as 0.25. Which audit? This is tough. I mean, we're taking a reduced level of control risk approach because control risk is less than 1, so it's reduced. However, the controls aren't effective enough for us to rely on so much, so we're also going to have to do fairly extensive substantive testing. Plan detection risk is going to be 0.2. Where do you get that? Well, plan detection risk equal audit risk divided by ROM. We're pretending auditing standards say acceptable audit risk has to be 0.05 or less. I always set inherent risk at 1 because I can't control it. And if control risk is 0.25, then voila, my plan detection risk needs to be 0.20. Controls are effective. We assess control risk as 0.03. We're going to take a reduced level control risk approach. Plan detection risk needs to be 1. The formula spits out something greater than 1, but risk never exceeds 1. The probability of something bad happening can't be more than 1. Here are the assertions that relate to account balances. We're responsible for all 6 of them now. Vouching and tracing I think of as directions. I'm going to start with tracing. When we enter into a sales transaction, we receive a purchase order from a customer. We create a sales order. We create a shipping document from the sales order. When we ship the goods, we create an invoice from the sales order and shipping document. And we post from the general ledger, from the sales invoice to the general journal and then the general ledger. So tracing just follows the direction, the order the transaction actually occurred. We're going to pull a sales order and find a corresponding shipping document, corresponding invoice, trace it into the journal and then the ledger. Vouching, on the other hand, goes the opposite direction. Vouching, we'd start with the sales journal, and then we'd find the invoice that supports the sales journal, the shipping document that supports the invoice, and the sales order corresponding with the shipping document. When we're auditing assets, we're typically concerned with overstatement and existence. When we audit sales, we're typically most concerned about overstatement and occurrence. When we audit liabilities, we're worried about understatement and completeness. When we audit expenses, we're typically most concerned with understatement and completeness. Accounts receivable, overstatement, existence. Cash, overstatement, and existence. We're going to assume that's true in this class, but we have to be careful because sometimes smaller companies are more worried about taxes than they are their financial statements. So some smaller companies may have an incentive to understate sales to reduce their taxes. But in our world, we're going to assume all our clients are concerned about have incentive to overstate sales, overstate assets. Now, cash receipts. Cash is an asset, but we're going to split cash into 2 pieces. We're going to audit cash receipts and cash disbursements. And when we split it in 2, then cash receipts are transactions. So we're worried about overstatement and occurrence. Cash disbursements, we're worried about understatement and completeness. There's 2 ways I can overstate cash. I can overstate the cash receipts, or I can understate the number of checks I've written. Tomorrow we'll discuss substantive tests. Thank you and have a nice evening.